became the host,
Okay.
but she's back in now, it looks like.
Yeah, she's the host.
Who's the host?
You are,
You are.
Oh,
but we lost you for a second, and
you did, because I turned on the recording for Majid's otter, and I said, wait a minute, I need the recording because I've had some people ask me, can they, see it after? So I want to be able to post it. All right, so it's 5:31 and I've already done the first faux pas by, ending the meeting for myself a little early. I want to say thank you very much to everyone who is here. I am very, a little bit surprised, but also very happy that there were so many people that wanted to know more about whole life, because out of all the things that I have done since I've joined Sub 2, and I have my trust and I have my first asset and I've done a couple of loans and things, I'm starting to get going. And I have an Airbnb with Abraham. So I have to give that one the top billing. But I would say, I don't know, maybe not. Getting whole life insurance on my family is the best thing I have done so far for them and for myself. I'm just going to speak for a second, and I'm going to pass it over to Tyler. When I came into my inheritance, I didn't want to waste it. I wanted to double it, more than double it. I wanted to keep it going generationally. And I wasn't sure how to do that other than to gladly work my little tush off, because I love working and I love real estate, for the future generations. I could have retired completely, gone to a beach, done nothing if I wanted to, because I've got more than enough money to last my life. But I didn't want to do that. And I met, Pace and Abraham and all of you, and that's changed my life immensely. But when I realized that I could also use my money twice through whole life, I was super, super excited. And Pace had brought in a company which I thought was really good. I did speak with them a couple of different times, but I also spoke with Mary Kang, who is here, and she's in Sub 2. And Mary is a very intelligent lady. She's a NYU professor in dentistry and a dentist by W2. But she's already got me buying gold for my grandbaby, all sorts of things. And when I realized that she was licensed in this, I was like, dang, that girl's never going to stop growing. She's just learning so damn much that I decided I would look further into the company that she went with and that she is an agent with. And that is how I came to Tyler Wille, who is a partner in a Life 180. Now, that's how I came to them and how my trust is in them. Frankly, I think that as long as it's whole life, they're not that different. It's the personal care that you get that's the biggest difference. And I am super grateful. And if you guys decide, nah, ain't for me, good. At least you're making an intelligent, educated decision. Or if you decide, no, I'm going to do IUL, or I want to go with another company. It's about none of that. I don't care. What I really care about and what I'm very excited about is that your questioning made me realize, oh, I actually can help in other ways. I can actually put together a little thing and get some answers for you. So that's why we're here. So thank you very much for coming. And I would like to introduce Tyler, who is the partner that I am working with, and that Mary is working under also. So Tyler, could you introduce yourself to the group and
yeah, thank you.
get us
Thank you
going?
so much for putting this together, Effie. So just a quick 30-second intro about myself. I'm Tyler Wille. I actually live down in South Florida. I've been in the industry now for 10 years, and all of my mentors are well into their 60s. So I learned from like the best from people that have been doing it for 30 plus years who actually practice what they preach. About 3 years ago, I became a partner with Life 180, and our primary goal is just these infinite banking uh, policies, which we're going to talk about today and how it relates to real estate. I agree with everything Effie said on there's not a huge difference between all of the whole life companies as long as you go with a mutual company. I would say the biggest differentiator is finding an agent that's going to service you and serve you for the multi generations, right? So the policy is going to do the same, but I'll tell you what, it's really easy when you have somebody to call that can walk you through different scenarios of, hey, here's what I'm thinking, here's, this problem or this property or whatever, and have somebody that understands and that can walk you through solutions. So I would say that's the most important thing. So without, I'm going to kind of dive right into it. I'm going to share my screen, and when I walk away, it's hard for me to read the chat because I'm going to be on the board behind me, kind of drawing and going through. Effie asked a ton of questions, so if you see the chat, just unmute yourself and ask. I'm going to try to keep this informal, and depending on how many questions we have, I also have a kind of like a real life scenario using like illustrations and real numbers that we can go through as well for those that are interested.
That would
So,
be very helpful to understand the concept fully.
yeah.
Because when I saw the numbers on what I was going to be putting in and what my children's death benefit is going to be and what the cash value is going to be, my eyes went, oh, yay. I was so excited. It makes a difference to be able to know. And the difference between Sammy, my grandbaby, who's a year and a half, what her policy grows to versus a 40-year-old versus a 70-year-old. Anyways, okay. We'll
Yeah,
let
the
you know if
only
there are any
thing I will
questions.
say that I disagreed with Evie is I would never recommend or I would never sell an IUL. So we're going to talk about the difference between whole life and IUL. Everything else, I 100% agree with her. But I do care, and I'll show you why I don't think IUL is right for anybody, and I'll share some real life stories of that I have come across with people that have those. But we'll save that kind of towards the end, and we're going to cover a little bit throughout the presentation. So this whole presentation is really, and it's quick, it's going to get right to the point. I'm not one to get into fluff. I'm a numbers guy. So this is all about understanding why it can help you become your own bank. Okay. It's all about why whole life is such a good leverage tool. And that's what we're going to discuss. So the first thing that I always like to talk about is what makes an ideal investment,
Hey,
right?
Tyler, is there any way you can further enlarge that? Sorry.
Is that better? And you can kind of full
Yeah.
screen me.
Yeah, that's what I'm going to do. There we go. Can everybody see that? Okay, I think we're much better. Thank you so much.
Okay. So what makes an ideal investment? There's a whole list here, and I'm not going to talk too much about all of them because they're all in different asset classes. But what I will say is what I find most individuals that are interested in the things that Effie talked about intergenerational, wealth and real estate and all of these things is they boil down to they like assets that they have control of. They like assets that they can leverage. They like things that are private, and they like, safe, but mainly consistency. The other two things is anybody that's in real estate loves the tax benefits associated with it. And then they like the fact that it yields income, right? So those are kind of the things that I think are more important than rate of return and all those other things. To me, control is like my biggest one when I look at real estate and being able to control kind of my own destiny on that regards. So what kind of makes the most sense is now you have three types of people, okay? So you have all these different ways of what different people identify as what is an ideal investment to them. And then you have three types of people. You have the person that is a debtor, who is somebody that takes a loan and is always in debt. They pay that debt off, and then boom, they take another loan, and they're never really getting ahead because they're just continuing going into debt and then paying that debt off. Some people do it in real estate. I think real estate is a leverageable asset, but people that are always going into credit card debt, or people that are always financing cars, so on and so forth. The next person is the saver, the person that is certainly better than the debtor, but the person that is saving their money, and then once they have enough cash, they purchase it outright. And so the problem with the saver is an efficiency problem. It's a good problem to be a saver over a debtor, but you keep interrupting what we call this compounding curve, which is what a maximizer kind of does. So they can see here that this compounding curve never goes up, and although you're taking money from it, you're still growing that curve. And so that is where time does help, right? The younger you are, that time value curve goes more in your favor, but it works for everybody. So let's talk about a little bit about what the banks do, how they do it, because the banks are doing the same thing, and you'd be surprised of how much of it they're actually using whole life. Okay. So after the 2009 crisis, they basically formed a committee. It's called the Basel Committee. You can look all this up. And what they did was they set tier 1 leverage ratios in place. Okay. And basically they came to the decision that anywhere between 3 and 5%, which is mind-boggling that it's that low, depending on the bank size, is a financially strong company that has 3 to 5% sitting in a tier 1 reserve account. So it's all based on their reserve account. You can see here, from there, they leverage money on a fractional banking. I could do a whole presentation on fractional banking. Not a huge fan of it. I think there's a lot of problems with it. But you can see the big banks, they're holding above 5%. They're holding 8.5 to just under 8 from a tier 1 asset. Now, I always get this question, what is a tier 1 asset? A tier 1 asset is an asset that is easily convertible into liquidity within 48 hours. Okay? And there's only 3. You have actual cash, you have money market, and then you have whole life insurance. And so the first thing is I'm using whole life, not just cash value life insurance, because IUL is not considered a tier 1 asset. Only whole life is. Okay. So I'm not going to get too much into fractional banking, but basically the banks take the deposits and their reserves and they loan it. And, you'll read things online that they loan, your deposit up to 10x, when actuality it's more, because bank one will give a loan. Well, then that money ends up hitting another bank, and that bank loans it. So that's the fractional banking situation, and I think it's a nightmare, but I'm not going to talk about it too much. So from there, how do maximizers leverage? Okay, the traditional methods, right? And I believe all of you are doing this from the talks that I've had with Effie. You have your traditional, which is public or bank, which is like your traditional financing, right? You're using a smaller down payment, 5% to 20% to purchase a house, where that house is in kind of financing itself. Or you could go private into the private money lending arena, higher interest rates, but there's a reason why people still go to PMLs in order to get financing, because everyone's still making money. Okay. The last other option is you can collateralize an asset. Okay, so you can take an asset, so HELOCs, which is, collateralizing a property, 60 to 80% to get a line of credit. You can do portfolio lines of credit, which take a percentage of someone's brokerage account portfolio, 40 to 60%. Or you can take, and we're going to talk more about this in a couple slides, you can take a actual cash value line of credit on your cash value insurance policy of somewhere between 90 and 100%. The other option is lines of credit, which are just, I'm not going to talk too much about that. I think everyone knows, but you're taking your credit score in order to get a line of credit through a bank. My only issue with all three of these methods is it puts all of the control with the bank. They control everything. They control the rates, they control the payments, they control all of those things. You lose the control, okay? So how does it work? Okay, everyone, and so now I'm going to get right into it. So the first thing is, and I will back all of this up, so I'm going to give my opinion, but it's going to be a very strong opinion, so just FYI. You always want to use whole life, and you always want to use it from a mutual company. So I think the first question that I always get is, what is a mutual company? A mutual company is a company that is owned by the policyholders. So when you buy a policy with a mutual company, you become an owner in that company, and all of the profits that that company makes gets paid to the policyholders in the form of dividends, okay? And when I say paid to the policyholders, these companies have been paying dividends every single year for 150 years, since 1850s, a lot of them.
So I'm going to interrupt you for 1 second and
Yeah.
I'm going to underline that by how freaking crazy is it that these mutual companies have been in existence for 150 years and, Americans have been benefiting. I love the fact that they're almost like a nonprofit. They give it back to you from whole life. And we are just finding out about it. So thank you, Tyler.
Absolutely. And I want to put this in perspective because a lot of people don't realize 1850s has seen two iterations of the US dollar. So the US dollar as we know it today has seen two changes since 1850. So these companies, so when you hear some people, and I'm not a conspiracy theorist, or I'm not a I have some of my colleagues that are like, oh, the US dollar is going to be worth nothing one day. We're going to go to these cryptocurrencies and all of these things that are uncertainty. Well, I don't know about you, but companies that have survived two different currency changes, I put my money with them that they're going to adapt to whatever the future holds. Okay. And we can talk if you guys want to know more about how those mutual companies pay these dividends, like kind of what their strategy is. I'm happy to go into more detail about that. And I'm going to do a whole slide at the end about why I would never buy an IUL, any type of universal life policy. So, but we'll cover that at the end. Now, whole life is not an investment. Okay. So anybody that's comparing it to an investment, it's not an investment. It's not meant to be an investment. To me, it's a foundational tier one asset that you can leverage to take advantage of opportunities in what I believe, and I can show in the numbers, one of, if not the most efficient way to leverage that money. Okay. And I'm going to show a core example here on the next slide. But the core slide about it is even on your borrowed money, they are still going to pay you a dividend. Okay, so you're never interrupting that compounded curve. Okay, and then we kind of talked a little bit about the safety and strength of the insurance company surviving, two iterations of the US dollar, being around 150 years, and their reserve requirements are almost 5 times of what the banks are. So from a cash standpoint, so keep that in mind. So I'm going to actually come back to that slide in 1 second. So let's go through the core concept, because this is how dividends are paid on borrowed money. I'm going to zoom in here a little bit. Sorry if it gets a little blurry. So the core concept is, if you have $100,000 sitting in your cash value inside your policy, and you say, okay, I'm going to take a $50,000 loan. Okay. So that means that you have $50,000 left inside your policy that is going to be earning whatever the dividend rate is for that particular policy year. Now, these companies announce the dividend for the next year in between November and December. So, for example, like December 10th, I'm just going to use the first one that comes to my mind. MassMutual came out with their dividend, and they announced it at 6.3% for 2024. So I know before 2024 even starts what my dividend projection is going to be. Okay. Now we come to the left side of the ledger, and we can see, okay, I took a $50,000 loan. They are going to charge a 5% loan rate, and we're going to talk about loan rates in a second. That is $2,750 a year. However, they're still going to credit me this $3,000 dividend. So in this example, on this bucket of money, I'm making $250 even though I have this money borrowed. This is if I'm using this loan or this dividend to pay off that interest payment every year. There's a lot of ways to pay this loan off on a year. So under this example, you would end up with $3,250 of policy cash value growth. Okay. Now, I'm going to kind of give away the structure and some examples of how, before I even got into the business, my father, who's in his mid-70s now, was using this when I was 20 years ago, and still has a policy today. My dad was a general contractor in the commercial, but did a lot of fix and flips. So when I was in high school, that's all I did all summer. So what is the power of the difference of putting you into control? Okay. There's no required payments. You're borrowing the money. So in technicality, the insurance company is setting the loan rate. Okay. That loan rate is locked in for 12 months. And it can only change on your anniversary date. And the caps are 8% on most, if not all, the companies. They basically track the Moody's average corporate bond yield within a 0.5 point. So within 0.5%, that's what they're tracking. So you can always kind of Google and kind of tell what the insurance companies loan. And this is basically the 10-year treasury. Now, it is no required payments, right? Because you're borrowing it from yourself. And it's simple interest calculated daily. So you know exactly what it's going to be at the end of the year. Now, you have several ways to pay that loan off. You can use the dividends to offset or pay the loan interest. You can pay interest only. You can develop a payment plan. Or in that case that I just showed, whereas that positive spread exists, you can let the loan accrue and know your cash value is going to keep outpacing that loan. Okay. And then the last one is you can kind of, which I don't have listed, is you can take a cash value line of credit on the policy. You know, you give that control back to the bank, but when interest rates were really low 3, 4, 5 years ago, I was recommending everybody do that because that positive spread was greater. And so you always have the option to kind of flip back and forth, which is nice. Any questions so far? While I come back.
There was one question, and it was from Olga. Olga says, does the dividend diminish as more policies are sold, since your ownership would be diluted over more time as more people buy policies?
So great question. So let me do this. Well, that's a good question. So so the answer is no. So insurance companies, so how dividends are calculated. Okay. Now, dividends are calculated off kind of 4 kind of core concepts. Okay. So insurance companies, they handle both sides of what I call the mortality table. Okay. So most insurance companies, right, they're selling products with some type of guarantees. Okay. So when we talk about the mortality table, we're specifically talking about life insurance and annuities. Okay. And so when you guys see all these, and yes, there's annuities that you can purchase as an individual to generate income and all of those things. But the big player for annuities is basically every pension that is left is basically annuities wrapped up on a very large scale. And I know pensions are kind of a dying breed, but from like a general company standpoint, but there's still tens of billions of dollars in pension funds that are healthy across the United States. So let's talk about that mortality table. If you live too long, right? If you live too short, it's a loss for the insurance company. Because if you paid one life insurance premium and died next week, the insurance company is going to pay that claim. The longer you live, the more dollars the insurance company makes on that side. From a standpoint of, on the annuity side, it's completely flipped. So the shorter you live, the more money the insurance company makes. And the longer you live, the less money the insurance company makes. Okay? So with actuaries and life expectancy and all of those things, they can calculate a profit. And I am not an actuary, but they calculate that profit based on life expectancy and all those things. So you have mortality is a way that the company makes revenue. And then you have the fact that they're taking all of the insurance premiums and they're obviously making a profit, right? They're not charging you at cost, and they're taking those insurance premiums, excess claims, right? So let's say there were, I'm going to use very small numbers for easy math, but let's say they have $1 million in claims in a year, and it's more like $1 billion. But if they have excess of $1 million where they were expecting $1 million in claims, and then they only had 500,000 in claims, meaning deaths, they're taking that excess and all the additional insurance premiums, and they are investing this. And when I say investing, they're not investing in the S&P. They're investing in super long-term things, treasuries, mortgages. Their time horizon of them investing is 100+ years. And if you're more interested in that, they produce an annual report every year that they send out to every policyholder. It's public, and you can actually look at the balance sheet. All these big insurance companies, they have real estate holdings, hotels, commercial buildings. They have all these subsidiaries that help them make a lot of revenue, right? They're all about long-term consistency. That's what they're about. You'll never see big swings in dividends because dividends are more tied towards interest rates. Interest in a lower interest rate environment, they're not getting as much on that consistent investing. So the more policy basically doesn't diminish dividend returns. It actually strengthens company reserves and gives them more buying power. So hopefully that answered that question. So I'm only talking about one core strategy, you know, because that's and it's definitely one of the core strategies that I think is most valuable, especially for real estate investors. But there's a lot of purposes of owning whole life. It's going to outperform most bonds. If I look at policies that are 30 years old, they've averaged between 5 and 6%, which is better than most bonds. There is another one here, asset protection. It is state mandated and every state's a little different. But here in Florida, cash value that's sitting in your whole life is 100% creditor protected. So it gives you a lot of creditor, you know, asset protection things. You can also use trust strategies like Effie was mentioning at the beginning of the call to in the states that don't give you that straight up protection. And because it's so liquid as a tier 1 asset, it makes a great emergency reserve. Some other things that we didn't talk about, but like legacy was, Effie was saying, legacy is another big one. And I see a lot of it as a hedge or buffer because basically it's a non-correlated non-correlated asset. Okay, so what does that mean? When the stock market goes down 15, 20%, your cash value once earned can never go down unless you're taking money from it. So during those years in 08, 09, you're not going to see a drop in your whole life cash value. And so a lot of people use it as a buffer to weather those storms, which is a totally different use that I see. Any other questions? I can't see the chat, so.
No,
Not at
we're
this
good.
time.
Okay, so if you don't trust me, right, let's talk about who else owns it. So there's a thing called BOLI, which is bank-owned life insurance. That's what it stands for. Bank of America has 13 billion in whole life. JP Morgan has 7 point, and these figures are a little old, like from like 5 years ago. Wells Fargo, 16.8 billion, JP Morgan, 7.1 billion. The average, what I call A-rated bank, like super large national bank, has 15 to 30% of their tier 1 capital in whole life insurance with one of the big mutual companies. So if you think about that, that means like I know Bank of America is like 28% of Bank of America's tier 1 capital, which is what they can use as leverage, is in cash value insurance. So if they are doing it in order to leverage it, then we're trend, in my opinion, that says they've been doing it for 100 years. Clearly it's been working.
And the ironic thing about that is that when we keep our money in those banks, we're just letting them do it. you know,
Correct.
And they're making the profit. It's just crazy.
Absolutely. And so, you know, there's a whole list. I just pulled some of the big ones, but these are companies where every single one of their executives is taking bonus plans using whole life, where the companies are paying the premiums and using kind of what I call like golden handcuff strategies and a bunch of things like that. But you can see it's not one industry. It's the finance industry. It's the, pharmaceutical industry. It's the healthcare industry. It's tech. It's motorcycle. You know, it's automobile. It's credit cards. Every single company, industry, the big ones, they all use it. And there's actually something called COLI. So these are people that are doing it on an individual level. COLI stands for corporate-owned life insurance. So the big companies, they actually just have insurance companies on their balance sheet for the same reason that you and I would be using it to leverage. Like I'll give you an example. My uncle worked for a company, and he worked his way up as an exec, and they were a very large cement company out in the Virginia area. Every single one of their large equipment, which was millions and millions of dollars, they were financing most of it through their COLI, through their bank-owned life insurance, or through their corporate-owned life insurance. So I've seen real-world examples through that because I became friends with them, and it was fascinating to me. So that's basically all I have. Don't trust. So I'll open up to questions, but I did want to cover one thing about IULs versus whole life. So IUL. Oops. So I'm going to mainly, I just kind of talked about how whole life and kind of why whole life. So I'm going to just really kind of hammer why I don't like IULs. But for the first part, the biggest one is stock company, right? So that means a difference between the stock company and the mutual company is profits are going to be paid to stockholders first. Okay. So right away from a core concept, I know that all of these companies are in it for the stockholders, not really for the people that hold policies at all. So that's just like a big core thing. So the four main reasons of why that I think IULs are destined to fail, and I've looked at hundreds, if not 1,000 different in-force illustrations, and I would put myself to debate anybody if anybody ever wants to. Happy to do it. But let's talk about the four key things. The first one is a rising cost of insurance. Okay. So that means no matter what you do, there's always going to be a cost of insurance inside these policies that is increasing that you can never get. And when you're young, it's not as big of a deal, but you would be shocked of how expensive life insurance gets when you hit 65, 75, and 85 years old. It becomes a very, very, very expensive proposition, okay? Where whole life is a level, keyword, guaranteed payment.
From the time you buy it.
From the time you buy it, that's
Right.
correct. Yes.
So for most of you people out here, I am 70. I'm not getting the same rates as you guys are going to get because that's when I'm applying for it. So for those of you who are actually going to grasp this and do it, it behooves you to let people your own age and younger know the sooner they get started, the wealthier they're going to be, and the less their insurance will cost. It will be, set on their birthday when they buy it. That's an important point.
Yes. Yes, it is. And there's all sorts of, this guaranteed payment depends on age, product, company, and now they're all loosely similar, but everyone is the reason why I'm not really talking too much about a specific product or a specific company or product within that company is because everyone's situation is differently, right? So depending on what your ultimate goals are, some companies might be slightly better for you than others. When you look at what those not so much what that product policy is going to do for you, because they're all going to do the same thing, but what you specifically need it to do. So the next one is, it's tied to an index. Okay, so these are all tied towards an index. And my biggest issue is there's some that are S&P 500, which is at least okay, but there's a lot of made up indexes. Okay, and so the problem with these indexes that nobody ever seems to talk about is they do not include dividends. So dividends are excluded from the return. Okay, so think of companies like AT&T, if you're down south, Nextera. Apple gives a dividend every year. So any dividends are excluded. And if you look at that as like a historical percentage, that's 10 to 20% of the S&P 500. Okay, so that's number one. Number two is they're what we call a point-to-point annual point-to-point, meaning what's today's date? It is the 10th, right? So if you were to buy the policy today, June 10th, they're going to look at the value of the S&P today, and then they're not going to look at it again until the 10th of 2025. And whatever that value is from this date to this date is what your policy is going to be credited. Okay. So if I see a lot of times is if you don't time when you purchase these policies perfectly, you could have all this growth from June 10th of now to May 10th of next year. You could have 20% growth, and then you could the S&P could drop 20%, and so for that year you're going to get 0% just by 1 month of performance of an S&P 500 that you have zero control over. The next thing is they set caps and participation rates. Okay, so a cap is they're going to say, even if the S&P does 10%, we're going to cap you at 7.5. So the max you're ever going to be able to get is 7.5, or a participation rate says 80% of whatever the S&P 500 does. Okay, and it's not so much that these are bad or good, even though I would say it's a lever that you lose control, right? So you're losing control, but the company reserves the right to change these caps whenever they want. Can change whenever they want. Okay, so you have that. Now, the way that all these IULs are sold is, oh, well, yeah, they give you this cap, but you have this 0% downside protection. So that means if the S&P loses, right, you are guaranteed to not lose any money. And that is the biggest lie of all, is because not only do you have the cost of insurance and the policy fees, which are incredibly high, you also have a potential loan rate. And I'm not going to go down the rabbit hole, but I could show an illustration. They always show this loan rate of that positive spread because that's what the illustration allows for them to illustrate. Whereas the dividend rate is way more consistent, 150 consecutive years through Great Depression, through 01, through 08, through World War II. From all of those major events, these insurance companies paid dividends above what they guarantee. Here, if you have a 5% loan rate and you have a loan of 500 grand, well, you're going to have the cost of insurance, you're going to have the policy fees, and then you're going to have this loan expense. And so your policy value is going to go down. And so if you learn anything about sequence of returns and go down that rabbit hole, you can never really recover from a few bad years, especially the older that you get. And then the last kind of thing is really along the lines of all of the risk is on you. They're charging you the cost of insurance. They are taking advantage of all of the upside through caps and participation rates, which they can change at any time. And then they're getting all of their money back, and all of the risk is on you. And so my point is if, in my opinion, I don't think insurance as a whole should ever be sold as an investment. And so if you want to take risk, that's fine. Just don't do it through the policy. Just invest the money. This whole life over here is designed to be that foundational asset, that consistent growth that you know in no matter what, it's going to give you a dividend. Once the cash is earned, it's never going to go down. And you can then use that to leverage and take advantage of real estate through loans. So that's kind of my big, strong opinion. I'll tell a quick story. So my uncle
Can
in
I say
his,
one thing before you tell that story for a second?
yeah,
I think that the most telling difference, and that, everything else just stems from it, in the difference between whole life and IUL, is that if I'm owning a whole life policy, then I have ownership in that insurance company. I have
Yep.
ownership. So that means that they're going to do, you know, I'm doing what's right for me. But on the IUL, if I buy a policy, I'm always going to be a customer, and that's it.
correct. Yep.
And a customer is never going to get the same. It's almost like if you're renting versus owning a house,
Yep.
right? It's there's just all the rest of it comes from that in a way.
I agree 100%.
Sorry, I didn't mean to cut you.
No, that's,
Hey,
and
and
so,
Tyler,
yeah, go ahead.
is there a list of what companies we're assigned to, or do we pick what companies that we
Yeah,
get to get dividends from?
yes. So I'll give you the quick list, like the top 5, right? We represent all of them. There's pros and cons of kind of each company depending on your situation. So I'll say that. And when I say pros and cons, just nuances of, maybe you're looking for more long-term cash versus short-term, the ability to maybe do what we call a front load deposit, so there's a lot of things. All of them are good. You have your big kind of what I call 4 is your Mass Mutual, your New York Life, your Northwestern, and your Guardian. And then you have just underneath that tier, you have Lafayette, Ameritas, and One America. So those are kind of your and some of those do not have the right loan provisions, but I'm just talking from a mutual company standpoint. Those are kind of like your 8 core companies that you want to, that are mutual, that have been around for 100+ years. A-rated, Comdex, I mean, been around forever. You can't go wrong with any of them, in my opinion. So yeah, if you want to reach out to us, I'll leave my contact information or reach out to Mary. But
And is that what you mean by the product company?
yeah. So then each one of those companies have like sub products, and then and they're all whole life, right? So
Okay.
a quick kind of a way that I describe base whole life is a lot like a mortgage. Okay. So all of you kind of are going to grasp this very easily. So when you have a mortgage, right, and a traditional mortgage, those first few years, you're really not hitting a lot of principal, right? You're just paying a lot of interest only in the beginning. As that mortgage amortization happens over 15, 20, 30 years, whatever that mortgage period is, you start hitting way more principal as that mortgage length, kind of comes across. Whole life at its core works exactly the same. You're going to have different products that have different pay schedules. So 10-year period, 20-year period, pay till 65, pay till 100. All of these different products, you're going to have if you're going to pay till age 100, right? And I'm 32, I'm going to have a way lower cost of insurance because the insurance company thinks I'm going to pay this forever, right? Versus if I'm only going to pay 10 years, they know that, hey, we have to have this product guaranteed, this death benefit guaranteed, the dividends that we guarantee all, done in 10 years. So from 32 to 42, right? So all of those things are going to weigh different costs and flexibility and all those other things. So those first couple of years of the whole life, you're kind of paying for all of that insurance cost that you'll never pay again, and then it's going to grow equity. Now, one thing when we design banking policies is we talk about overfunding them to where we try to get more cash in the policy early, but long term, they're all going to equal out. So hopefully that kind of makes sense on like how whole life works with guarantees. Like there's a guaranteed product interest rate, and that is how now every single company for 150 years has paid more than the guarantee. They've never not paid only the guarantee. So
Audra says, of those companies, do any of them take away your
Nope.
guarantee for being late on premium, even once you're during ownership? And I think I know the answer to this one. No.
that's right.
Uh,
That is the answer. So you're thinking, I've heard this happening, right? So if you miss payments on like a GUL or a term or a IUL, they can actually remove and change those caps and remove some guarantees based on when you made the payments. With a whole life, because there's I'm just going to use like a 20 pay, right? So I have an L65. So my policy is I'm going to pay till I'm 65. And so I have enough cash, right? Where if I don't pay my premium, I can lower it a little bit if I need to. But if let's say, whatever, right? Bad couple years, money wise, can't afford it, have another opportunity, whatever it is, you don't need a reason. I could use some of the cash to pay my premiums. I could use dividends to offset my premium due. And then I also build in flexibility for like being able to lower the premium if I need to. So using those extra, using those options is not going to take away any of the guarantees. It might just slow the growth down because you're not putting in 1 year versus another. Which happens. I mean, for example, so I know we're kind of running out of time, so I don't think we'll have time to go through my real estate example. I mean, I'm happy to kind of do a quick 5-minute and we can have another call of like a real example, but I'll give my 2 stories really fast. So before I got into the business, through my uncle's company that I was talking about, he worked for Superior Paving, really, really large company in Virginia for they pave all the roads. Well, they purchased IULs, right? By mistake. They ended up correcting that mistake. But my uncle then got diagnosed with Parkinson's. So Parkinson's, uninsurable, right? Can't get insurance if you have Parkinson's because the insurance company says, well, odds are you're not going to live very long. So I manage his IUL every single year. He's in his 60s now, and it is a pain every single year. Every single year. And he's not taking any money from it. He's not taking any loans, but I need it to last till he's 75, 80 years old for like Effie's, like the pure purpose is legacy, right? The company's put in all this money. He's put in all this money, but that cost of insurance is increasing so fast that he has to put in more money every time the market doesn't do well. He purchased it in, October, which historically Q3 in the S&P 500 is the worst quarter ever. So Q3 is never very good. Q4 is always pretty good. So like he bought it at that index, timed poorly. And so I see it firsthand every year when I say, hey, we should fund 5,000 this year to make sure everything's good. We should fund it 6,000 a year just to cover costs of insurance. Every single year I do that for him. So I've seen firsthand, and that's not somebody that's taking loans for income or real estate or leveraging or any of those things. That's just keeping it alive. So
Tyler, you can't 1035 the IUL
he's
into a
uninsurable.
whole life for your uncle?
Yeah, usually I would be
they
able
won't.
to, but because he's Parkinson's, can't get any insurance anywhere else. So it's tough,
Gotcha.
So like when Effie was saying the younger people that start it, right? You're going to come across a lot. I have friends now who aren't insurable anymore. Maybe they got diagnosed with stage 2, type 2 diabetes, so like you'd be surprised between your 30s to your 50s, and Effie, I'm not your age, but when you get to 60s and 70s, you meet a lot of people whose health is not what it was when you were in your 30s and 40s. And so that's a big, thing about what we call like locking in insurability, especially for like children. Like I have a daughter that's 8 months old, and I bought a policy on her before, she's in the clear. So that's my 2 cents on that.
So out of curiosity, if a child was born with challenges, would the companies just not cover them?
Oh, the camera went out. Sorry. Let me see if I can get that back on. I think I had it unplugged. So the answer is, let me plug in my backup camera. Sorry.
That's a pretty screen.
So the answer is, from a quick answer is, it depends what it is. right?
Mhm.
If it's like a debilitating, like short life expectancy, they will notice, they will check. But you can insure a child up to 14 days old. So as soon as 14, you can buy insurance on them, and you would be surprised of the amount of things that you don't check for a 14-year-old or 14-day-old. So like I have a few clients that have had, osteoarthritis, they've had, depression as a kid, all these different things that come up just like with health for a young child. You can avoid that. So, it's hard when your child's 14 days old to have the mental wherewithal to like,
Oh,
hey, I
this
need
will
to
just
do
be
this when you're,
automatic. I'm going to, because when I got, the policy for my grandbaby, the fact that, because I wasn't really joking when I said Mary got me into buying gold for my grandbaby, but which is one vehicle, but this is so much better because I'm putting in considerably less for the kind of return she's getting on the money, how much she can borrow when she's 22, when she's 30, that sort of thing. It has real value, as well as her death benefit. Because whenever she dies, I would like for that money to go back into the whole life, get it set up for the trust so that hopefully she'll have children. It can go down multi-generational. So
yeah,
I think that when you
absolutely.
have a baby, it should be automatic. Like, okay, another policy, let's go.
So if you want to read a good book, it's called What Would the Rockefellers Do?
Right,
Okay. And it's a difference between the Rockefellers and the Vanderbilts.
right.
And I have several clients that do this from, like I said, my mentors are in their 70s now. And they set up trusts kind of like Effie did, where there's money in the trust. And as soon as a kid is born, you're taking a policy out on them automatically. So everything is very structured in the trust, and they have family meetings and everything is organized. And you look 3, 4, 5 generations down the line, and the values are astronomical. And when I started running it on Layla myself, I was like, holy cow, like, it's hard to, when you don't have a kid and no one, and you're the first one to really set it up for your family, you don't really look at it. So it's super cool concept that I have really taken an enjoyment to since my daughter was born.
JB asks, how old does someone, oh, I see, to get the policy. Yeah. And it doesn't stop. I mean, as long as you can afford to pay it and you're in good health, you can get it even at my age. Sorry.
And the minimum, guys, just to have an idea, what I call like the minimum commitment is 7 years. I don't want to go too much down the rabbit hole, but there's some IRS limits that the IRS set when people are trying to avoid taxes, because you can access these policies tax-free. So obviously the IRS came in and said, hey, we got to keep an eye on these. So they set some limits back in the 80s. And if you pay 7 years and come up against financial hardship or don't want to pay for any reason or whatever, you can always take what we call a reduced paid up and have it, there be no more cost of insurance, no more premiums, and your policies are just going to grow. So it's not like a lifetime long commitment, even if you plan on it being, you say, hey, I'm going to do it for 20 years. And year 7 or year 10, you come around and you say, hey, like what, no, you can stop it and have the policy grow from there. So there's a lot of flexibility.
It'll still compound.
Correct. Yep. Mm-hmm.
I think that even if I wasn't the age I'm at and have, because I came into a certain amount, all at once, and if I was going to be earning it, I think I would try and push myself to get it at least one policy for each person done in 7 years. Because I know that they would be 7 years older and all that and getting others, but the idea of not having to think about it, know it's always paid and it's growing. That's why I love those charts. Why don't you pull up one of those little charts and show us a bit? Because that's what got me, is the numbers.
Is there a minimum on an annual policy? Is it 100 grand, 50 grand? What's the minimum to
Every
open up?
company's a little differently. Typically, it's by face amount. So like the minimum death benefit these insurance companies want is somewhere between 25 and 50,000. And I'll put it in perspective, depending on that length that you're willing to pay, right? It's very inexpensive. So like, I'll give you an example. The first policy I bought when I was broke and just got into the business at 21 years, 22 years old, I bought a $50,000 policy and it was like $40 a month, right? So like, and that was not overfunded or anything like that. I didn't get fancy. I didn't know about those things at the time. But you can see that, that kind of cost, right? So yeah, I see a bunch of questions. So you can always borrow about 90% of what the things, and then I see a good question. Does the interest adds to the policy or the cash value? So the interest is, so like what a lot of people do, right? And I'll give this example, is I'll tell you what my father and I did. John Wille, right? We had JMW Construction Corp. John Wille owned his insurance, his whole life policy himself, right? And then I'm just going to use 5%. So he would take 100 grand and he would say, okay, I'm going to borrow $100,000 from the policy. And the policy loan was 5%. So it's costing him $5,000 a year, simple interest calculated daily. He would then take that $100,000 as a John Wille, write a contract to JMW Construction Corp, and charge JMW Construction 8%. He could have charged whatever he wanted, right? So now JMW Construction Corp is receiving this $100,000 and they have to pay 8%. Well, that interest is a deduction, right? As an interest expense, just like it would have been through the bank. There's some CPAs that will just kind of do it naturally. Some, like, I'm not a CPA. There's some in the gray zone where they want you to write that contract, so it's kind of formal if they ever get audited. I'm not going to, talk to your CPA about that. But then my dad was able to use real estate, right? And the depreciation and renovations and, flipping, everything that you can do in real estate to basically show a loss on the property, and then repay the loan when we would flip it. So, there's a lot of creative ways. Now, the interest would accrue the loan, right? So the interest could increase the loan, or you could pay it off, pay interest only. A lot of times I tell clients to pay interest only, especially if the real estate or private money lending is generating income, right? So that way there's no interruption in the compound curve. What I call being a responsible banker, you want to pay at least interest only, manage that debt, but it's all about managing the debt. I have a guy who took $750,000 out of his policy 2.5 years ago, 3 years ago now, and he bought a commercial building. And the deal only made sense if he could pay interest only for 3 or 4 years, and then all of the lease agreements were up, and he knew that the lease was well below the market value. And so he's hitting year 3 now. He's going to be able to turn around and almost triple his lease, so his cash flow. And he's not sure now. Originally, his intention was to sell it once he re-signed those leases, but now he sees how much cash flow that can generate. He's like, all right, maybe now I start paying the loan back. But the fact that he only had to pay interest only for 3 years at a 5% loan rate was a no-brainer for him.
Yeah, JB.
Yes.
Yeah, you're answering JB's question?
Yeah, so it is possible to move an existing policy into a trust. And yes, it is typically a revocable trust that people use that becomes irrevocable upon whatever you specify in the trust.
Yeah, that's what I'm doing, JB. I had set my trust up already. I've got some of the things in it that, he had told me to put in, like bank accounts and such. But as soon as the whole life is completely finished and being set up, I will put that under the trust too. Because it does take time. And I'm not sure if it was just because of my age and all, but it took a little bit longer than what I had thought to get the policy, because they do send out a nurse, they do go through your medical, they do, they do all that. And, as a result, I say don't waste time. Like if you're going to do this, know that it's going to be better if you do it sooner than later, because you're younger, and because you can put your money to work. But as soon as I get it completely under the trust policy, the trust, I'll be able to, I will have grown. I will have grown from not
all
having
about
a trust and not having a whole life and not being able to use this vehicle to make more money to being able to.
it's all about steps, right? So I had bought term and I converted it as I made more income, as I made more money and all these things. So there's a lot of options to grow into the policy, right? And it's all about understanding that. So Effie, I would love to maybe come back and go through like a real example, because it will take quite a bit of time to show, like, for all those that are like really into the numbers, which if you're like
Okay.
Effie,
Okay, I get you. I
so-
could talk, listen to this all night because I'm so excited I've done it. Like, like they still have a couple of accounts to pull through but I'm there.
but if
But
you
I
want to
agree.
share my screen, I will show the difference of a quick summary of a 15-year mortgage compared to like finance, if you had enough cash to finance it yourself.
Mhm.
And I can show like the interest savings, but to go walk through like all the math will take a while. So,
Okay, and you know what? If there's enough of a demand, they can reach out to me and or Mary and we can set it up. Okay, so I think you can share your screen.
okay. So this is a traditional mortgage calculator. I did not create it, but I've checked all the math. It's a company, Vertex. They come up with really good Excels. So all this Excel is really saying is, if I were to buy $150,000, and I'm trying to use just very general numbers, right? If I were to buy a property for 150,000 at 5.5%, this Excel is about a year old from an interest rate standpoint. So yes, I know interest rates are a little higher than 5.5. But if I were on a 15-year note, right, 15 years, that monthly payment would be about $1,200. Okay, $1,225. Okay, so obviously that's just the monthly payment and property taxes and everything else. But we're going to focus on just this $1,225. So if we look at the summary over a 15-year period, which is 180 payments, we're going to make a total of $220,000 in payments, okay? Or pay $70,000 in interest. Now, yes, I know you get some deductions for this, and I know the real estate is going to appreciate, and obviously you might be cash flowing, but that is your cost. That's your investment cost over a 15-year period. So what I said is, okay, well, what if I had $150,000 sitting in my whole life policy, and rather than financing through a bank, I just financed this myself? How much further ahead would I be after 15 years? And am I saying that's like the most efficient? No, because if interest rates ever dropped really low again, I would say refinance, pull the money outside of your cash value, use that leverage to do multiple deals. But just from a A to B comparison, okay, and I'll show the illustration in 2 seconds. But let me just do that now. So
It's on the same sheet. Oh, okay.
sorry. So if you had taken this loan, okay, just so you can see I'm using real things, I'm going to flip back to the Excel in a second. I know this is the first time anybody's potentially looked at an illustration, but you can see the loan coming out here. I showed no more premium, so you're not making any more payments. And then you're paying this $14,700, which is the $1,225 that the mortgage payment would have been. You're paying your policy back, okay? And if you look at the value, which is now imported in here, so everything's just for those that are in the numbers, you will pay that loan off in 11 years compared to 15 using the same payment, and it will only cost you $150,000. Okay. And so your savings is basically almost the entire, I'm not saying you're paying nothing in interest, but your total savings is $70,000 plus it's like 11.2 years. So you're saving 3.8 years on an actual payment, and you're saving a lot of money in total interest payments. So that is the power of non-direct recognition, simple interest calculated daily, right? So paying those monthly payments, your simple interest is you're really hitting principal much faster, and you're uninterrupting that compounding curve by net cash value 221, 252. So you could come back in and immediately borrow money out to do a second property or a third property or private money lend and all those other things. So maybe if enough people want to see this whole thing with a bunch of examples, I have this same example with the same numbers for a funding, a fix and flip, a car loan, a traditional mortgage, comparing it to a bank account or savings account of just paying cash. So all of those things I've built out to, and you guys can give me like numbers. Hey, show 4%, show 3%, show this, show that, and I can adjust it live.
All right. I want to say a thank you, and I hope other people will join me in saying thank you. Oh yeah, thank you, Ron. Ron said thank you to me too. Oh, all right, thank you. How can they reach you?
I will put my chat. I will put my Marion. Do you want to put your info too?
Sure. I also wanted to say one of the good things about life insurance that I learned is you could utilize your death benefit. As you get older, you have a lot of expenses that you need for health. If you can't walk or if you can't bathe yourself, you can utilize the death benefit while you're still living. And that death benefit doesn't have to be saved to get passed on to your legacy. So you can use it your whole entire life. So that's one of the most important thing I learned about whole life insurance.
Yes.
Yeah.
And that's absolutely, if I were to think that, yeah, if I wasn't thinking about whole, like legacy, I don't know what I would be doing, but I'd use it all up. You bet.
Absolutely.
All right.
It can be used in a lot of phases of life.
Yeah.
Typically, you use it to leverage, and then eventually it's kicking off, and then you want to transition it and use it for legacy or whatever. So,
And did you
hopefully-
put your information in here?
I did.
Okay. You did or you didn't?
I did. Yeah, it's in there.
Okay, then save the chat if you want to reach out to him. You can also reach out to Mary. She is in sub 2. Are you in Gator also, Mary?
No, I stopped Gator. I'm too busy.
Okay, and of course you can
Yeah.
reach me. So, thank you, Tyler. Thank you, Mary. Thank you to all of you who came. Yeah, I hope you learned something, and I'm happy to help. Okay, I'm going to say goodbye.
Thanks,
Thank
Effie.
you.
Have a good one.
Thanks.
Take
Bye.
care.
And Effie,
Bye.
what I'll do is I see somebody who started Nelson Nash's book. I'll put a list of some good reading books for you
Oh.
to share,
Excellent. Excellent.
because there are a few.
Yes, there's a recording of this, Celeste. I'm going to place it on my YouTube channel, but it takes a while to buffer and to do whatever it's got to do, and then I'll do it. So it won't be immediate, but in the next couple of hours. Thank you, guys. Take care.
Thank you so much.
Bye.
Bye.